This week, we're going to jump off of last week's commentary on the value of working an advisor and specifically focus in on clearing up some common misconceptions. So this week, we're going to look at 5 common misconceptions people have about how the stock market operates. This is partially inspired off last week's video, which I got a lot of great feedback on the value an advisor can bring as relates to experience, understanding how to keep things in perspective, what is quote unquote normal, as well as the written piece that I share in this week's commentary from Brian Westbury on the stock market is not the economy and or GDP. So we're going to go through these 5 misconceptions. Hopefully you find some great meat, maybe clear up a few things that you found yourself saying or wondering about. The first, we'll start right again with Brian Westbury's piece that the stock market is not the economy. This catches people off guard all the time. If you look at 2020, it was a great example where the economy was certainly struggling under those COVID restrictions, and yet the stock market soared. One, different time frames, different lenses is certainly part of that. The other one, again, is the stock market isn't all of the economy, right? It's for the S&P 500, 500 companies. There are also 2,000 more mid and small. And those companies, again, may be doing as they did last year very well or poorly relative to your neighborhood store. So again, understanding that is critical and not, again, usually see people get real bearish around what they view as an economic sign, or conversely, if the economy is doing all right, buying into stocks or a market at a valuation level that just doesn't make sense. So decouple that in your mind. Kind of related to that is point number 2, that what the market really cares about is rates of change, not absolutes. So an example I'll use for people is company A that's going to make $1 million for 5 straight years profit. Company B that's going to maybe lose $1 million, lose $500,000, break even, make $1 million. But it's got an upward sloping. The second one is quite honestly the stock that the stock market's probably going to reward because it's got that positive rate of change, that growth associated with it, even if over that 5-year period, it's going to have less absolute profits. That's one. For the economy, same type of notion or at various points of data. It isn't just about absolutes, but is it trending upwards or trending downwards is really what the market's trying to deduce all the time. And so it's one of the big reasons people get caught off sides after a prolonged bear market is they still look at things as being bad. They're not focused on the fact that it might be getting less bad, and how the market views less bad is very good. Point number 3 is what is a good return? This is a question we get all the time, or I'll hear people talk about, hey, I think I did really well. I made 8% last year. It's all relative to how much risk that you've taken. If you were in an all stock portfolio in a year where the stock market was up 20% and you only got 8, that's actually a horrible return. Your friend who might have only made 5%, if they were in fixed income and took very little risk, maybe that was a great return compared to your 8. So again, understanding where you fit on the efficient frontier in terms of risk and reward is key. Some people might want to take a little bit more, some might be less. What's critical is that you're optimized for the long-term rate of return you should get for the amount of risk you're taking. And this is, again, something that an advisor can help you look at and see to, again, make sure you're properly allocated, which is one of those Vanguard values that an advisor can bring to the table is proper allocation. 4th point, the market doesn't care about your intention or your timing. This first point, intention, relates a little bit to that risk-return dynamic. I see all the time people will talk about, well, this is my growth portfolio. I'm going to take a lot of risk in this. That can be your intention. You can call your portfolio whatever you would like to call it. It doesn't mean that's going to manifest in results. Nor does taking a lot of risk necessarily mean you're going to get a lot of return. The market also doesn't care about your timing. A common thing I see, particularly from people maybe nearing retirement, is that they're like, well, I really want to try to maximize my gains here in my last few years, not keeping in mind the market might go risk off right before you're about to retire. If you harken back to last week's mention in the written piece about sequence of returns risk, Google it, encourage you to do it. The last few years of your working life, the first few years of retirement, critical to maintaining your portfolio balance to extend the longevity of that portfolio and not suffer a significant drawdown. With couples, statistically having one or both spouses live to be 90, longevity is critical. And again, matching up that risk for where you're at in your life is a key component that an advisor can help you with. And a key misconception we see people do is, again, they've got their plan, but that plan rarely matches up with what the market might have in store. The fifth is just bad signals. The laundry list for this could be very, very long. But as we touched on last week, clients just looking at the wrong things, not understanding how markets actually operate. I'll give you a few quick examples of this. Talked to no less than 4 or 5 people last week who told me they wanted to increase their bond allocations because they heard interest rates would be going up. Up sounds good, sounds positive, like the stock market going up. Had to inform them that interest rates moving up would actually drive bond values down. Common misconception I've seen time and time again. Similarly is related to bond yields, and we shared understanding what to look for. So many people, again, just look at the market, stock market down bad, stock market up good, never looking underneath the surface. As we touched on last week, if you look at, we're in the midst of about a 5% pullback, completely normal. In fact, this run we just had was about twice as long as the historic average between 5% drawdowns. And yet some funny things, if you actually look beyond just what the S&P 500's done, you'll see that the Russell 2000 small cap stocks were up and outperforming things like Treasury, gold, consumer staples, more defensive type positions. That usually isn't indicative of a market that's going to have a prolonged drawdown where defenses are struggling vis-a-vis things that are more growth. We shared the chart last week from Bespoke showing how credit spreads haven't moved at all. If you're going to see a prolonged risk-off event, usually you'll see the bond market act in kind. Trading ranges, sentiment. Here, everyone around me feels like the stock market's going to go down too. That's usually the signal that the stock market's about to go up. And if you look at things right now on both a moving average basis or an investor sentiment, very oversold, almost 2 standard deviations oversold. The last time we really brought this to your attention was December of 18. Had a bunch of people thinking I could predict stock markets. I couldn't, but you had extreme oversold valuations. We saw the same thing last March. That's your signal that it's usually closer to the end than the beginning. And if you have dry powder, that maybe it's something you want to get to work. So again, understanding context, point number 5, so critical. Hope you've enjoyed these 5 common misconceptions. Love chatting about this. So if any of you have questions, feel free to reach out anytime. Thanks so much.